and welcome to the Eightfold Specialist Finance channel. Today our main topic is going to be managing property development construction, but we also want to talk about a few things we've seen in the news over the last few days.
Yeah, so in our weekly blogs from now on, we're going to change it up a bit, and at the start of each week we'll talk a little bit about what we're hearing and what's been in the news that week relative to the property market. There's always a lot of movement in the market, and there's lots of things going on just at the moment which we think are of value to talk about. So a few things. This week I think we've got Auckland median house price information coming through from CoreLogic, which we think is worth talking about. Council ratings out, valuations going up there. Auction numbers, we're seeing some changes there in the market with auctions not necessarily been as successful and not necessarily looking like the preferred method in some places going forward for a little while. Supply chain, we've still got these problems in construction around supply chain which come up week after week, and we'll talk a little bit to that, and tying into that, prefabricated housing. So let's start out with the median price piece. So this week, Rob, we've seen CoreLogic come out with its numbers in terms of what's going on in the housing market based on sales, and we've seen things come off the peak in November last year, where I think in Auckland we had the median price for a house in Auckland at 1.54. It's come back to 1.25 million just at the moment. What are your thoughts on what's going on there?
Yeah, it's a pretty dramatic headline because I think it's a 19% drop from the peak, which over a few months is pretty significant. But I think the issue is that we're not necessarily comparing apples with apples because that median house price is a median average.
Yeah.
So I think CoreLogic themselves said that one of the issues was that more lower valued housing had been sold. Yeah. So it's not really a reflection of the market as such. Yeah. It's a reflection of the type of stock that has been sold. So, you know, it's a good headline, but
because we've had a huge bubble of new stock coming through, probably one of the biggest in the history of Auckland, really, when you think about what's been going on out there. But that stock is, you know, you've got a lot of lower value housing, apartments, terraced, likes in that mix.
We know that townhouses, you know, every man and his dog was out there trying to fund townhouses, and obviously they have lower value, which will have a skew on that median house price. Yeah.
So then on the other side of things, we've got the new council valuations coming out. Everyone's getting their letters this week. You know, that's the 3-yearly revaluation of things in terms of assessing rates. They're up 34% on what they were in, 2018, was it that we were last done? I'm not quite sure, but 3 years ago. And, you know, we'll see rates rise as a reflection of that, but I guess you can sort of see the compounding catch-up that Auckland's been going through.
Yeah, I mean, look, I think those rates revaluations are probably indicative of where the market's gone. We all know how strong it's been over the last couple of years, the last few months maybe notwithstanding. But I suppose for most people, you know, it's nice to get a council valuation that says your property's worth X amount, but, you know, it's what you pay your rates, really, isn't it? That most people are going to be focusing on now with this cost of living crisis, or not crisis, depending on who you listen to. But yeah, that's the key, isn't it? You know, what's going to the rates bills, not necessarily what's happened to your CV.
Yeah, and I don't think those council valuations are keeping up with market, even at what we've seen coming through. And so I guess from a investor or a property owner point of view, that equity position is still going to be tied back more to what is coming out of the CoreLogics or velocities of the world in terms of valuations. Yeah.
And I mean, as a general point, I see that quite a few of the banks are forecasting, you know, 10% falls, maybe some more than that. But it'd be interesting to see because interest rates are still low by historic standards. So I've seen a few economists come out and say, you know, that more of a consolidation than the fall, which, you know, ties in with my experiences where if affordability is there with low interest rates, you don't get forced sales. And my concern is more about volume in the market than house price falling themselves. Obviously, as brokers, if you're a real estate agent, if you're a conveyancer, you need volume. And I see that sales volume in February was down quite significantly compared to previous February. So my concern is more about the volume of transactions that might happen if buyers and sellers' expectations aren't matched.
Makes sense. So a bit of interesting sort of news around auctions. Obviously not been as successful. I think the success rates on auctions sort of dropping from the 40s down into the mid-30s, and in some parts in Auckland I think I saw Barfoot and Thompson talking about rates as low as in the 20s. So I guess we might see the real estate companies start to change their sales tactics a little bit as well.
Yeah, I think so. I think it's a reflection of the heat going out of the market. Obviously auctions are great when you've got lots of people bidding against each other, but it's a different dynamic now. Obviously, some question marks over finance with I know they've rolled back some of those changes to the triple CFA, but there's still a little bit more of a question mark over finance. You don't want to buy at auction and then find you can't sell your own property. So a lot of factors going into that. So you're right, I think we'll see less auction, probably more negotiation, and conditional purchases subject to sales, a bit more normality, I'd say, than we've seen in the last couple of years.
Supply chain, I mean, we're still hearing a lot from developer customers that stress is still there and that it's putting pressure on project timing. Yeah,
I had a chat with the QS last week and I said, how many of your projects that you're monitoring are past due at the moment? He said all of them, which is a pretty strong indication that those supply chain issues are still there.
I think a good thing to sort of consider there is that we kind of hear about the cost of the goods, if you like. So the supply chain, there's a restricted amount of product coming through and therefore the cost of jibs going up, for instance. But I think the bigger issue is probably more the time cost in terms of that every day a project gets pushed out, you've got those finance costs and other bits and pieces that you're compounding over that period. That's not been talked about as much, but I think that could be the issue for the developer market in the next 6 months or so.
Well, it's a well-worn statement that time is money, but it's definitely true if you're running the development, particularly if you're running with a non-bank provider who charge a higher interest rate because every month that goes by, more interest being accrued, eating into that profit margin. So, I think there'll be a few developers a little bit nervous about the time delays.
I guess we've got a lot of finance out there in the non-bank space at the moment, and non-banks typically do the sort of shorter term thing on the basis of we'll roll it over, but it's always at a cost because you're rolling over the fees. So I guess it's a little lesson actually for developers just to be really careful around that sort of planning piece and realising that they may actually be better off pricing in those rollover fees as part of the overall project because more likely than not they're wearing them. So
I would say is that it's the happy time when you draw the loan down and everyone's optimistic.
Exactly.
And then it's the unhappy time if you've backed yourself into a corner, as you say, if there are rollover fees, if you haven't given yourself enough time, if you've been overly optimistic about when things are going to sell. So definitely it's a kind of thing, it's subjective. And I've had that with clients that they look at the black and white of what's the fees and what's the interest rate, but there are subjective elements in there, the what ifs, what if I have a problem? Is this a lender that's going to work with me? Or is this a lender that's going to be quite rigid and just try to charge their fees and play hardball? So, it's things like that a lot of developers don't necessarily take into account.
I think, the sort of conversation as to, we'll look after you, we'll roll over is always kind of a best endeavour at the time. But the other problem you've got with small finance companies is that liquidity on the day is different to what they might think it was going to be when they wrote the loan 6 to 12 months before. And they may not have the money, and it's that old caveat that's in all bank docs these days around if we don't have the money we can't roll the loan over, and we all understand that, but we just don't want to be too comfortable with the idea that there's always capital available from a lender. I I think
Yeah.
that's the key thing.
But we've seen that over the last few months with that squeeze in the non-bank liquidity. With smaller lenders having repayments they're expecting, they're not coming back in. The money that is available, they're charging a premium.
Yeah.
And so, if you don't have your finance locked out to cover the whole project and the time that you need, then you could get caught in that squeeze.
Yeah. And last thing on my list was there was a bit of an article in the paper this week around developer in Hobsonville bringing in prefab out of I think it was Vietnam. Prefab comes up in time and time again. It's in theory, it makes a heck of a lot of sense because you're building off site in all weather. You can really control those conditions in terms of the build. You can be really strict around the actual cost of build and materials that you're using in bits and pieces. And we've seen many tries at getting this right in New Zealand. It answers a lot of the problems that we have around the supply and demand piece where we've been sort of forced to use the big players in terms of product providers in New Zealand. People are trying to look at how they can do or how they can bypass them and go directly offshore for supply. So it solves those sorts of problems. It solves the problems around dealing with building in the wet in winter, all those sorts of things which we hear about. It solves the problems around the actual quality of workmanship because you're doing a lot of that stuff in a controlled environment somewhere. But we haven't actually seen much success. So is this something that you think is going to fix some of the problems that we've talked about?
Yeah, the headlines are fantastic for modular or prefab. Faster construction time, cheaper construction costs, which everyone is looking for. Unfortunately, the realities of the market haven't really kept speed with what's available because, first of all, funding modular from a development point of view is not necessarily straightforward.
No.
Because the things are made off-site. A lot of lenders are nervous about putting money into the scheme if those materials aren't actually on the site where they've got their mortgage.
Yeah.
So that's issue number one. If you're looking at finance, it can restrict what you can do with modular.
Yeah.
And then on the back end, finance for end buyers of modular construction is an issue.
Yeah.
So it was an issue in the UK as well. I had a few clients looking at modular, but in reality, the only ones we could really get away were ones that involved local authorities. So they'd have an agreement with the local authority to try and produce lower cost housing for council rental stock.
Yeah.
So funding wasn't an issue because it was forward purchased by the council and they weren't looking for mortgages on the back end because they were retaining it for tenants.
Yeah.
So that public model, it kind of worked because you took the finance out of it.
Yeah.
But on the private side, issues. So I think lenders and banks need to sort of get up to speed with what's available on modular before we really see that part of the market develop.
Yeah, and the lenders always put that risk hat on around that code of compliance piece and, is this modular project going to get the tick in terms of the council side of things too? And, you've got potentially product issues if they're not certified New Zealand products, all those sorts of things that those companies have to work their way through before they can offer this sort of product into the market full stop. But then there's that unknown around how your finance industry is going to feel in terms of comfort from a risk point of view.
So developing area, but slowly developing, unfortunately.
Yeah. Okay, well, let's get on to this week's topic. So this week we're talking about managing the project construction side of things through a project and thinking about the risks and bits and pieces there. I think we're going to kick off with a little bit around sort of the two options which we see, which is the developer doing everything themselves versus subcontracting it all out. Why don't we start there, Rob?
Yeah, so just to explain that, you've got third-party contractor. So here's Mr. Developer or Mrs. Developer, here's the contractor, unrelated party, and they go into an agreement to build out at a price. Owner builders are where the developer is also the builder, and they manage the subbies and the subcontracts. I've had issues before, particularly where a building firm or a construction firm wants to do their own development. And obviously they're used to their own costings, and they quite often say, right, well, you can build this for X amount, and that gives us a nice profit margin on this development. But you go across to the lender, who appoint a QS, and they're going to look at it at market rates, because the lender will say, well, look, if there's a problem and we need to step in, Mr. Builder, we can't use your firm, we need to go to the market and we'll pay market rate. So I have seen a few clients sort of come, not unstuck, but a little naively thinking that they can use their lower cost of being an owner builder. But from the lender's perspective, they're always going to go to their QS and say, what are the market rates? So from a lender's perspective, third party contractor, fixed price, that's the best option for them. That's the safest option. I think if you're an owner builder, you probably need to show you've got a good track record of delivering schemes to get lenders comfortable, but be aware that they're probably going to build some contingency in just because you're not, maybe you're having a profit margin, you're not using market rate. So it's an approach that will vary from lender to lender and from developer to developer.
And I guess it's fair to say in New Zealand that at the smaller end of the market, a good chunk of it's subcontracted out. And to get to that sort of turnkey piece where you've got the developer doing everything from buying the land through to planning it, developing it, that tends to come later as they've built up that experience and got a team and things around.
It does, and that is really driven by the lenders to make sure that schemes don't hit any bottlenecks or have any issues. And of course, the traditional model, fixed price contract with a third party contractor, going back to our supply chain issues, obviously that's been a problem more recently because fixed price contracts are sort of not really available right now, and contingencies that are being demanded, 5 or 10% might have been standard, now it's probably 20%, just because of that variation in cost. So obviously it's been an issue for schemes that have started under one set of assumptions and then costs have blown out, and you've seen contractors not honouring fixed price contracts or just saying that they're going to walk off the site because it's not economic. So it's been a lesson that how quickly things can change if you don't get that construction piece right.
And I know a lot of you out there have sort of had this issue where the bank or the financier is asking for a fixed price contract, which in the current market is almost impossible to do because there'll be some clause for escalation of price and all those sorts of things. But talk about fixed price contracts and how they work and why they're important for the lender.
So in principle, the fixed price contract gives the lender certainty on what that cost will be to deliver the finished product. They will always build a contingency in as well, just in case, but it takes a lot of the risk away and puts it on the contractor to deliver that scheme for the price. So that's why not only is the contract amount important, but the contractor that sits behind it is very important as well. Now, if you've got a big multinational firm, well established, offering a fixed price contract, strong balance sheet, lenders are going to be very comfortable with that scenario. If you've got a fixed price contract from a newly incorporated firm, no track record, no balance sheet, that's going to make lenders nervous because you may have a fixed price contract, but if there are issues, what's the strength of that covenant that's sitting behind the contractor? And it could be that someone's bid on a job, they priced it too low, they're losing money, so they just fold the company. That's a worst case scenario. And then you've got everyone's nightmare, part completed scheme, contractor's gone bust. Trying to get someone in halfway through is always difficult. So they're the kind of things that make lenders nervous.
And there's two things there. I guess you've got the brand, if you like. So lender looking through and going, actually, we know that brand. They've done other things for other clients, and they're good operators. But then you've got the individuals, and in that building space, they do move around. The big guys will leave the corporate and set up their own construction company. So the people are really important too, aren't they, and all of that. experience.
A lot of subjective judgments
Mm.
in the specialist finance piece.
Mm.
And as you say, if someone's come from a big firm to set up a small firm, they've got a good track record,
Yeah.
all those things, it's all shades of grey.
Yeah.
It might be, a really strong house builder, but then they've contracted to do an apartment block. So even that sometimes throws up question marks to say, what's the experience of that particular type of construction?
Yeah.
So there's a lot of factors that go into the assessment.
Yeah. Yeah. No, okay, that's good. You've touched on contingency, and I think there's probably a day when we used to put a 5% contingency in place, and then it sort of went to 10. What's going on there? What are you seeing in terms of feasibilities, and what are people putting in terms of their contingency?
Well, as I said, up to 20% at the moment, just because of the escalation we've seen in supply costs.
Yeah.
Really, from a lender perspective, in the current market, the bigger the contingency, the better, because you just don't know what's out there.
Yeah, do you think they're putting in enough thought around, so you talked exactly about supply just then, and that's kind of traditionally contingency was about material overruns, not time overruns.
Not time overruns.
Do you think they're putting enough emphasis into that at the moment? Is that part of that increase to 20, or is it?
Well, I think hand in hand with the increase in contingency is you see lenders building in longer terms. Because as we said, it's the monthly interest bill that can rack up pretty quickly.
Yeah.
So from a lender's perspective, on a scheme that you might have factored on a 12-month loan previously, now you might be looking at 15 months or 18 months, just so you can keep to your back-end LVR ratios. Because obviously, the longer that scheme goes on, that interest bill is racking up. Lender's security margins are eroding. So if they build it in at the front and say, okay, we're going to put aside 18 months interest instead of 12 months interest, great for the lender to build in extra safety margin. But obviously, from the developer's perspective, that just means he's got to find more money up front to make the numbers work. So again, it comes back to that squeeze that we've spoken about. And highly geared finance and developers getting by with sort of 10% of cost or 15% of cost, more and more difficult because of the reaction, the reality of the market.
And I guess one of the areas that we've seen a lot of over the last 5 or 6 years is banks not really favouring doing anything with someone that's brand new, first time developer. That's still very much the case. That's what you'd expect to see?
Yeah, look, at all these things, it's never say never because there are individual circumstances, but as a general rule I can say that banks like people that have a track record that can point to a scheme and say, yes, I built this and sold it and finished it and paid everyone back and I took my profit and then rolled it into the next scheme. For a first-time developer, the bank route is difficult. So often the route for clients is with a non-bank lender, get a scheme under your belt, maybe a second one under your belt, and then get to the point where you can go to a bank. But obviously there are other factors with the banks, as we know. Pre-sale conditions is a big part of the bank thinking, and not every developer can or wants to have that pre-sale condition in place where they want 100% or 120% sometimes of debt covered by qualifying pre-sales. And qualifying pre-sales normally means 10% deposit paid, buyers checked out, everything verified. It's just another layer of paperwork. So that's why it comes down to that trade-off between pricing and conditions. How much paperwork you want to provide, how many conditions do you want to meet before you can get on site. And that's why not relying on one lender can be quite important because, as we know, lenders run out of money, appetite changes, risk profile changes, prices change. So you might have a fantastic relationship with one particular lender, but I know this from back in the post-GFC days. Mr. Developer, Mrs. Developer, great relationship with a bank or a non-bank lender. Suddenly they've gone bust or they're out of money. They're not in the market anymore, and people were left high and dry. So you really need to make sure you're not reliant on just one source of lending.
So you're a visionary sort of developer. You've gone through and done all the thinking. You've got the site. You've worked out what you're going to put on it, and then we get into the day-to-day construction phase. Where do things change there, and how does that mindset need to change along with it?
Yeah. Look, I'm stereotyping developers here, but most of the developers I've dealt with are kind of big picture people. They see the opportunity, they see the site, they see what it can be. They like that concept stage, they like doing the negotiation. But the best developers are the one that can swap from that mode to the really detailed, micromanaged aspect of running the construction. Because as we've spoken about, every cost overrun or every time delay eats away at the profit. So a lot of developers that I've dealt with, it's almost like they feel the job's done once they've completed on the land and everything's just going to be fine, where it's not. It's the ones that really drill down to the details of what's happening on the site day to day that are really successful, because they keep their costs down, they keep it on time, on budget as much as possible, and they're the ones that maintain that profit margin on the back end and don't have it eroded by cost overruns.
So let's talk a bit about cash flow management. Tips. What do you?
Yeah, well, again, going back to dealing with sort of novice or would-be developers, which is a lot of this is really aimed at. We'd spoken about cost to complete concepts previously, and sometimes, developer clients of mine haven't quite worked out what that means in reality, because you settled on the site. Let's say you've got a $10 million build. That's your cost to complete. You've got $10 million in the fund from the lender, and they're going to run it on the cost to complete. Now there's a bottleneck at the start, because you need to get that job underway. You need to spend some money on site to start the process. So let's say your first draw is going to be 100,000. You have to cash flow that 100,000. You've got to either with the builder or from your own resources get that contract underway, get physical work done on site, so that the QS can go out and say, yes, I can see 100 grand's worth of work has been done here. So Mr. Lender, you can draw down the 100,000. That goes on, and then the process is underway, and hopefully you deliver the 10 million cost, and you draw down the 10 million from the lender. But sometimes I've had clients not quite understand that there's that cash flow bit at the start.
That working capital cycle.
So you need to factor that in. And in an ideal world, you'd better draw enough on the finance from day one, leave a little bit of your own equity to one side to get that job flowing. But you need to factor that in as part of your feasibility.
Overruns, it's a market of overruns. We've got, I don't think there's a project out there that probably hasn't got a small overrun at the moment. What's the best behaviour for the developer in terms of managing that with the financier?
Well, again, it might be that you see some of the guarantees are in place from the borrower. Sometimes there might be a limit on the amount of principal they're guaranteeing, but cost overruns and interest is quite often included in there. So even with a contingency in place, most of the time the lender's going to look to the developer first to say, okay, there's a cost overrun here. You need to put your hand in your pocket to fund that. They like to keep the contingency intact. And again, I've sort of been in the middle of arguments between developer and lender to say, well, the contingency in place for overruns, so I want to draw down on that contingency, and the lender say, well, no, you put the money in first. So like a lot of these things, again, it's shades of grey, and it'll be negotiated around the time. So what's the problem? How has it arisen? Is it contained? And it might be that part of the contingency is used, part of it comes from the developer. But again, it ties in with that cash flow management you were talking about.
Yeah, I guess those days, and I guess it's one of the biggest changes in my career in terms of finance. Going back pre-GFC, developers came to the table with nothing almost. And that sort of idea of not having that balance sheet's almost a thing of the past now, isn't it? You've got to have that cash reserve up your sleeve to be able to manage those things in advance of the bank.
Yeah.
Yeah.
I suppose we're going on a slightly different topic here, but it's interesting that you see a number of developers here sort of raising their own finance or raising their own equity from investors, which is, it's an interesting model. I mean, it's great for the developer, and it gives those bigger developers a bit of they raise it as debt, but they really use it as equity. But I just wonder, in the current environment where site values are probably down, projects are overrun. Hopefully I'm wrong, but we could see some of those developers struggle a little bit to maintain the investor payments.
Well, I guess it's that old thing of risk and return, and I think probably what you're saying there is that the returns don't match the risks just in the current climate.
I think so. I mean, look, I don't know the ins and outs, but from the outside looking in, I get the impression that the money they're paying to the investors, or the interest rate they're paying to the investors, is probably lower than they'd get from an institution if they presented the use of money. So that'll be interesting to see how that all pans out over the short to medium term.
Anything else in terms of managing that construction project?
No, look, I think we've sort of talked around the major aspects there. As I say, really the key thing, if you're a developer, get on top, micromanage, make sure you're on site, and that's the best way to get it on time, on budget, which is really, really key.
Great. Okay, that's us for another week, Rob.
Okay, thanks, Andrew.
As we've said in the past, we're just starting to get an audience, but we're keen to hear from you as to areas that you might want to talk about, including those things that we've talked about at the start of today around the news. So, keep us up to date yourselves in terms of comments down below.
Okay.
Cheers.